Hi, and welcome to my overview of foreign exchange. Today we're going to be looking at some of the basic principles of foreign exchange, look at different aspects of foreign exchange markets, and look at how exchange rates are determined. So let's start out with that concept of the exchange rate. The best way to think about the exchange rate is just as a price of money. Now, it might seem odd to think about money as having a price, but just as everything has a price relative to money, money also has a price relative to other types of money. In other words, every currency has a price relative to other currencies. And so we can think about currencies as commodities, just like you might think of the price of a barrel of oil or something. A currency has a price in the market as well. So that's the exchange rate. There are various exchange markets. There are markets for immediate exchange, which are often called the spot market. And here, these are transactions that are designed to occur basically instantaneously. Many of the transactions do occur instantaneously with electronic transfers and things, but sometimes if you're using different kinds of instruments like checks, although not many people use those anymore, but other things like that, even credit cards, there might be a slight delay in the actual processing of the transaction, but it's still designed to be an immediate transaction. So these are spot market transactions. If you're a tourist traveling in another country and you are getting money out of an ATM machine, or you are using your credit card to pay for a meal or a hotel or something, all of those are spot market transactions. They are transactions that are cleared through your bank with an exchange rate at that moment, and essentially an immediate exchange. So businesses also use spot market transactions. Anytime you see if you're doing import-export activity, if you see the symbol T/T, that's a term for wire transfer, and that's an immediate exchange or immediate transfer of currency. So it's fairly common to have spot market transactions in foreign exchange, but it's also actually fairly common to have forward market transactions. So in addition to the market for immediate exchange, there's also a market for future exchange. That's what the forward market is. So just like other commodities that have futures markets, currency also has futures markets. The typical forward contracts for currency are 30-day, 90-day, and 180-day contracts. And so you'll get a different exchange rate in the spot market than you will in these forward markets. Sometimes it will be a better exchange rate, sometimes a worse exchange rate. Just depends on what the market feels is likely to happen in the future with that particular currency. Convertibility is another very important aspect of foreign exchange. In order to be able to do business in another country, you have to have confidence that you can exchange your currency for the other country's currency and vice versa. Convertibility is sometimes limited, though, by governments, depending on the situation in a particular country. Some governments might be somewhat insecure about their currency or their financial condition and might impose restrictions on the convertibility of the currency. Now, it used to be that there were a lot of currencies that were essentially not convertible to other currencies. Back in the days of the Soviet Union, the ruble, the Russian ruble, was not convertible to Western currencies. But most currencies today are at least somewhat convertible, if not fully convertible, but there still remain some restrictions, and occasionally you'll hear announcements of governments adding new restrictions that limit convertibility of their currencies. Really, for a country, though, to be efficiently integrated into the global market, it's really necessary to have a convertible currency. And so any country that takes steps to limit convertibility is also limiting its access to global markets. It's becoming less of a less desirable destination for foreign investment, and is kind of dimming its prospects in the global market. So convertibility is an important factor that countries have to consider and can't take lightly. Putting restrictions on convertibility has severe consequences, but often country governments see that as a trade-off, that they're willing to accept the consequences because they're worried about other consequences that might occur if they don't put those limits on. All right, so the volume of foreign exchange on foreign exchange markets has grown tremendously. If we go back all the way back to 1989, every day there were about $590 billion worth of foreign currencies exchanged on currency markets. But that continued to grow, as you can see here, steadily growing through the 1990s and dramatic increase into the early 2000s. Slower increases in the late 2000s because of the financial crisis, but still increases. And those have continued in recent years. A slight dip from 2013 to 2016, but in the most recent data, an additional increase. So as of this year, the average daily volume of foreign exchange is over 6 trillion, 6.6 trillion. And that compares to stock transactions. So the New York Stock Exchange is the most active stock market in the world, and it averages around $68 billion a day. So that's much less than the $6.6 trillion a day of foreign exchange transactions. Just to put that into perspective a little bit, the U.S. GDP is around $20 trillion a year, and so that means every day about a third, a little bit less than a third, but close to a third of the entire U.S. economy is exchanged on foreign exchange markets every day. That's a third of the entire annual output of the U.S. economy. So the scale of transactions on the foreign exchange market is quite staggering. So you might ask, well, who's conducting these exchanges? And the answer is that, well, on the one hand, it is companies that are actually doing business internationally and need to exchange currencies to conduct that business. But that's actually a relatively small percentage of these transactions. I've seen quotes around 10 to 20% of foreign exchange transactions are related to actual business dealings. The rest are mostly large hedge funds, pension funds, banks, others that are in the markets using currencies as a financial instrument and trying to profit off of the fluctuation of currencies against each other. So speculation is a huge driver of those markets. All right, an exchange rate regime is the set of rules that is used by a country's authorities to first set the exchange rate, or set the exchange rate of that country's currency, and then over time change or adjust that exchange rate. So there are different mechanisms that can be used, different exchange rate regimes that exist, and these range. Well, actually, let's back up and let's go through a historical view of this, of what the different exchange rate regimes, dominant exchange rate regimes, have been at different periods of time in the recent past. So if you go back to the early 20th century and the period before World War I, most countries in the world, and there were many fewer countries at that time and many fewer currencies, but those currencies that existed, they were largely on a gold standard. Now, a gold standard means that for any currency that is issued, the government that is issuing that currency has an equivalent value of gold on deposit somewhere that will back up that currency. Now, there are a lot of different ideas about the gold standard. There are some that support gold standards very strongly and others that are against gold standards. I tend to be more against the gold standard just because, there are certainly some advantages to a gold standard, but there are also some serious disadvantages. And the whole concept actually doesn't make a whole lot of sense. If you're thinking about, I don't want to diverge here into a whole lecture on monetary theory and the value of money and the theory of money, but I'll divert somewhat to that. So on a gold standard, when you issue money, you have an equivalent amount of gold on deposit to back that up. But what it means in practice is that you are just burying a bunch of gold, and when a government does transactions with other governments and things, when balances change, then you're moving these piles of gold around just from one pile to another pile. It really is just a very expensive accounting mechanism. You really could just keep a ledger and accomplish the same thing, and it doesn't necessarily have to be a pile of physical, tangible gold. It seems like you go to a lot of trouble and expense to build up these reserves of gold. Now, people that are in favor of gold standards say, well, but that's what gives the currency its value. And I would argue that no, that's not what gives the currency its value. The thing that gives currency value is our collective trust in the currency and our willingness to accept it in exchange for goods and services. And whether we have a gold standard or not, that doesn't seem to affect most people's willingness to accept currency. It doesn't necessarily erode our trust in the currency if it isn't backed up by gold, especially gold that we never see or don't even really know for sure. If you want to go through conspiracy theories or something, the government could be saying that there's this gold to back it up and it isn't really there. Now I'm getting far afield there, but in this age of conspiracy theories, why not throw one out? So a gold standard is, again, controversial. It does limit a government's ability to print money, to issue currency. And so in that way, those who are in favor of gold standards say that it controls the actions of central banks and limits their ability to create inflationary pressure by issuing too much currency. That's true. I will grant them that argument, but that doesn't necessarily mean that we have to have a gold standard to accomplish that goal, if that is an important goal. And also the downside of it is that in times where there need to be stimulus measures taken by the government to inject capital into the economy, inject liquidity into the economy, then they are severely limited if they're on a gold standard. Anyway, we'll get to that in a minute here. I jumped ahead a little bit, but got too excited when I saw that gold standard. So before World War I, most countries were on a gold standard, most countries that issued currencies. And if you are on a gold standard, what that means for currency exchange is that you are in a fixed exchange rate system. All the currencies are tied to gold and at a fixed rate, and therefore every currency is tied to every other currency at a fixed rate. It's an easy math problem. If you know how much gold your currency is worth, then you know how much your currency is worth relative to all currencies, and it just is fixed there. It does not change, does not fluctuate unless the government changes the value of the currency relative to gold, and that comes through an announcement, an official government announcement. So it's a very different kind of way of dealing with currency values and exchange rates. Under a gold standard, everything is fixed, the fixed exchange rate system. Well, World War I was an expensive undertaking. Countries were not able to maintain that gold standard. They decided that they needed more spending than the gold standard could support, one of the weaknesses I was saying before. And so most countries went off the gold standard after the war or during the war. So between the wars, between World War I and World War II, when countries were not on the gold standard, well then you're no longer on fixed exchange rates, you're on fully floating rates. So what is your currency worth? It's worth whatever the market will bear. So now you have a currency market and it's changing all the time. Rates are fluctuating based on all kinds of different factors, and rates are floating, not fixed. All right, well, if you remember from your history lessons, the period between the world wars, the 1920s and 1930s, and largely from the late 20s through the late 30s, was a period of tremendous political and economic instability, not just in the United States, but throughout the world, and particularly in Europe, Germany, most of all. So this political and economic instability, brewing tensions, Germany ultimately launching a Second World War, all of these things led to huge fluctuations in exchange rates, because if markets are based on information and if there is lots of uncertainty, then there are going to be huge fluctuations in those markets, and that was the case with exchange rate markets. And so what happened is that a lot of people then looked at the situation. They said, look, when countries were on a gold standard, everything was fine. Exchange rates were fixed. There was not a lot of uncertainty in the system. Things were rolling along just fine. Now, in this period of economic and political uncertainty, exchange rates have been going crazy. They're floating. So really, that must be the problem. Maybe it's the floating exchange rates that have caused all of this turmoil. And so the solution was to return to a gold standard. Well, unfortunately, this was in the midst of the Depression, and as countries returned to a gold standard, they often did so at unrealistic rates, at pre-war rates, because they were nostalgic for that wonderful past time, and also somewhat proud of their currency and everything. But things had changed a lot in the interim, so it was a disaster to go back to a gold standard at that time, and the Depression, which was already well underway, got even worse. Almost all of the economic actions that governments took in response to the Depression made it worse, not better, and this is another one. So the floating rate system was discredited because of a false association of causation. It was viewed as being a cause to the turmoil, whereas it was actually the turmoil that was causing the instability in exchange markets, not the other way around. And so going back to gold standard didn't fix anything, it just made things worse. All right, well, then we had World War II, and at the end of World War II, there was a huge movement, a global movement, led by the United States to create new global institutions that would ensure that there was more predictability, more stability, more structure in the global system going forward. And one of the cornerstones of this effort was the Bretton Woods system. So in 1944, finance ministers from around the world, at least from those countries that were allied in the war and were on the brink of victory for the war, they got together and created this new financial arrangement known as the Bretton Woods system. They had a meeting in Bretton Woods, New Hampshire. So what did this system consist of? Well, it was a dollar-based regime rather than a gold-based regime. So it was a system of fixed exchange rates. Countries pegged their currency to the dollar, and the dollar was tied to gold. So essentially it was an indirect gold standard. The dollar is on a gold standard. Other currencies are tied to the dollar. The price of gold was set at $35 an ounce, and other countries then announced what their currency was valued relative to the dollar. Well, that system was actually really stable from 1944 to 1971. It's quite remarkable it lasted as long as it did. But there were some problems that came up that created a lot of tension in the system. First of all, you can imagine anchoring the price of gold at $35 an ounce and not changing that for almost 30 years could be problematic. And the problem has to do with inflation. Although inflation was quite low in the 1950s and 60s, it started to pick up towards the end of the 60s and really picked up in the 1970s. But the fact that inflation was kicking in and there had been almost 30 years without changes put a lot of pressure in the system. It made gold prices unrealistic. Gold mining became unprofitable because you couldn't get a different price for gold than what the U.S. government set it at, since the currency is linked to gold. That's another thing. gold as a commodity becomes fixed, just like a currency. And so there was a shortage of gold. Well, that made things even harder. If there's a shortage of gold, then there's a severe limitation to how much currency can be issued if currency has to be backed by gold. So the whole thing began to unravel. And in addition to the gold problems, around the world, there were lots of differences in economic performance across countries, and differences in inflation rates, differences in growth rates. And those are all, if you have a fixed rate system, a fixed exchange rate system, there is no way to relieve pressure in that system that builds up over time unless you have revaluations, which countries occasionally would do. They would change their exchange rate to relieve some pressure, but it was just became too unwieldy, and ultimately the U.S. pulled out of the Bretton Woods system and it collapsed. And so since 1971, at the end of the Bretton Woods system, it's really kind of a currency free-for-all. There is no global agreement on how currencies should be managed. Each country is free to determine its own exchange rate regime, and these range from a pegged regime, where you have a fixed rate against some other currency or some basket of currencies, to fully floating currencies. So there are a few fully floating currencies: the US dollar, Japanese yen, the euro. Those are the major floating currencies around the world. And then a lot of other currencies, more minor currencies, tend to be pegged to some of those. The Chinese yuan, which is becoming a more important currency, but is held back by the Chinese government policies. They have limitations on convertibility. They also have they also set, they don't allow the yuan to float on global markets, so it's pegged to a basket of currencies. It used to be for a very long time pegged directly to the US dollar, but then they've expanded that a little bit to a basket of currencies. It gives a little more flexibility, but there's still not total flexibility there. So the yuan is not a global currency and continues to be limited. There are different approaches that countries can take to their exchange rate regime. There are relatively few countries that have pure regimes, other than the ones that I mentioned, with the yen, the dollar, and the British pound is also floating, and the euro. But most currencies have some kind of a combination of partly pegged and partly floating. Okay, well, if we look at governments and how they manage exchange rates, there are a few things that governments can do, even with a fully floating exchange rate regime. There are a few things that governments can do to try to manage those exchange rates. So this is really more from the U.S. government perspective. One thing that governments can do to manage exchange rates is to use reserve currencies. So governments buy and sell reserve currencies. So they might use their own currency to buy up reserves of other currencies. And then once they have those built up, they can then sell those reserve currencies to buy back their own currency. So that can be a mechanism for trying to influence currency markets by buying other currencies. It's all about supply and demand. By buying other currencies with their own currency, what I like to do is compare it to a stock issuance and buyback. So your currency is like a company's stock. So the more that you issue, the more currency that is out there. So in other words, if you are selling your own currency in order to buy reserves, you're increasing the supply of your currency, and that is going to depress the value of your currency. So it will weaken your currency if you are buying other reserve currencies. It strengthens the currency you're buying. It weakens your own currency. But on the flip side, if you're doing the other thing, if you're using your reserve currencies to buy back your own currency, then that's taking your own currency off the markets, like a stock buyback, and limits the supply of your currency and therefore increases the value. So governments can have a marginal, very small influence, usually through buying and selling reserve currencies, and that can happen kind of in day-to-day markets a little bit, but the volumes of exchange are so high, as we've seen, it's getting harder and harder for governments to have much influence here, because it's hard to deal in enough volume to really move the market in any significant way. But it is a technique that can be used. Another thing that governments can do, and this is much more powerful, is raising and lowering interest rates. So when central banks raise their interest rates, it tends to increase the value of their currency because it makes their country more attractive for foreign investors. With higher interest rates, people would switch their money into the high interest rate country money and put that on deposit in banks or through other investment options that would offer higher returns, and therefore raising interest rates generally strengthens a currency and lowering interest rates generally weakens a currency. Now, these kinds of relationships don't always exactly hold. A lot of it has to do with the difference between market expectations and reality. So if there's an expectation for lowering rates and then a central bank doesn't lower as much as expectations, it can have the same effect as raising rates, even though rates were lowered, but they weren't lowered enough to meet expectations. So there's also that factors into it. And there are other factors as well. So you really, in any of these relationships, you have to kind of think about all other things being held equal in order to understand what's going on. But so in most cases, all other things being equal, raising interest rates increases the value of your currency, and lowering interest rates weakens the currency. Then money supply, it's also about supply and demand. So increasing the money supply weakens the currency because there's more currency out there, it waters down the value, and decreasing the money supply or slowing the growth of the money supply then strengthens the currency because it tightens up the market for that currency. All right, so those are a few things that governments can do. Central banks do have an important role, and a lot of times when they're making these decisions about interest rates and the money supply, they're not necessarily thinking about the impact on the exchange rate as the primary motivation. They're doing it for other reasons, whether it's to combat inflation or to stimulate the economy. And the the exchange rate impact is a secondary effect, not a primary effect, at least in terms of the actions that they're taking. One final mechanism, which is, again, not always a direct effect, but would be encouraging or discouraging imports or exports. So in other words, if you're blocking imports, then that means you're making imports more difficult. You're putting tariffs on, trade barriers on goods coming into your country from other places. It means that your citizens are not buying as many goods from overseas. If you buy goods from another country, you are converting your money into that other country's money, and so it's the same thing as essentially selling reserve currencies. You're putting more of your money out there. You're increasing the supply of your money and increasing the demand for other currencies. So by importing a lot of goods, you are weakening the currency. A country that imports a lot of goods will likely see its currency weaken. A country that exports a lot of goods will likely see its currency strengthen. But those effects go exactly counter. So if your currency begins to weaken, then it becomes more expensive to buy foreign goods, and so the imports will likely decrease. Whereas if your currency strengthens, then your own goods become more expensive to other people. They will buy fewer of your goods, and your exports will decrease. So the exchange rates are an important balancing factor in keeping imports and exports from going out of control. Exporting countries generally have higher exchange rates. Their money strengthens, and that reduces their ability to export. And importing countries, their money weakens, which makes their exports much more attractive and makes foreign products more expensive, and therefore reduces imports and stimulates exports. So those are important balancing mechanisms, like a seesaw, that help to even things out in import-export markets. Some factors that lead to exchange rate determination over time. Well, we've kind of gone over these in the last few minutes here, but just to sum everything up, if we look at it in terms of short term, kind of medium term, and long term time frames, in the short term, in the day to day, and even kind of the week to week, and I guess we could even say, month to month a little bit, speculation is probably the biggest driver of exchange rates. So people are just speculating on what's likely to happen based on all kinds of information that's out there. But of course, people draw different conclusions with that information. But if the majority of people are drawing one conclusion, then it will move markets in a certain direction. If those attitudes begin to change, the markets will move in a different direction. So speculation as to what's happening in markets and what's likely to happen is a short-term factor, the largest factor in determining exchange rates over the short term. Another very important factor is interest rate differentials, and that can have an immediate impact when central banks announce changes in their interest rate policies. That obviously does have a big impact on exchange rates, and that can be immediate and also for the more medium term. So short and medium term interest rate differentials between countries do a lot to contribute to exchange rate determination. In a little bit longer time horizon, balance of payments. So as I was just referring to, the imports and exports, if you have more imports than exports, your currency is likely to weaken. If you have more exports than imports, your currency is likely to strengthen. So those balance of payments effects over the medium and long term can influence the value of the currency. It doesn't happen immediately because those things take time to kind of build up. So it's a cumulative effect over time that has an impact in the medium and long term, anywhere from 6 months to a couple of years. And then finally, over the long term, the most influential determinant of exchange rates is inflation. So countries that are experiencing high inflation will have or relatively high inflation, or higher inflation than other countries, will have their currency weaken, and countries that have low inflation will have, relative to other countries, will have their currency strengthen over the long term. So inflation is a very important factor as well. All right, I'm going to conclude this presentation then with a discussion of purchasing power parity theory. And what this theory argues in regard to exchange rates is that really the value of goods in one country versus another country really should be the same, the value of goods and services. So a particular kind of good in one country should, over time, balance out in terms of its value with the value in another country. There shouldn't be a difference. If I get a haircut in the United States, it should be worth the same as a haircut in China or in Mexico or Canada or wherever. So the value of goods and services should balance out over time. Now, there are obviously differences in the costs of different goods and services in different countries over time. But purchasing power parity theory says that if there is a lower cost of living in one country, that over time that currency should strengthen. Whereas if there's a high cost of living in a country, over time that currency should weaken relative to other currencies. So a more formal definition of purchasing power parity theory is that a change in relative inflation must result in a change in exchange rates in order to keep the prices of goods in two countries fairly similar. So it goes back to that idea: if one country is experiencing high rates of inflation, then its currency needs to weaken to be able to balance out the price of those goods again. All right, well, this principle, this theory, has actually been tested in kind of a tongue-in-cheek way initially by The Economist magazine, and they developed, it's well over 20 years ago, what they called the McDonald's test of purchasing power parity. It's also called the Big Mac effect. And so what they did is they said, well, what's a product that we could look at in the world that is fairly standardized, that we can find in many different countries? And they said, aha, the McDonald's Big Mac is sold in many different countries, and it's a fairly standardized product. So let's use that as a point of comparison. What is the average price of a Big Mac in different countries? And let's see how that changes over time to see if it supports the ideas of purchasing power parity. So if we go to the Economist website here, they have a special page just for their Big Mac index, and so it's gotten a little bit more sophisticated over time. The last one they released was in January of 2018, and it shows, it's interesting to track these over time, by the way. Their actual tool here doesn't help you do much of the tracking over time, but what it does is gives you a snapshot of what's going on right now. And you can see that, well, let's go to the US, for example. When we go over the US, it will tell us that the average price of a Big Mac in dollar terms, they argue, is $5.28. Now that does seem a little bit high just for the Big Mac, but that's an average value across a lot of different locations within the United States. So $5.28 is the comparison value. And then they look at it in other countries. So for example, in Mexico, it's much less. $2.57 is the average cost of a Big Mac in Mexico. In Canada, $5.26. Now this is, when you convert the average price in Canadian, which is $6.55, by times the exchange rate, you get $5.26 in Canada, $5.28 in the US, and you get $2.57 in Mexico. So you can see there's a big difference between Canada, the US, and Mexico. Canada and the US are almost the same, and the Canadian currency is slightly undervalued relative to the US dollar. The US dollar is always kept at an even level. It's the comparison currency. So of all the countries that they compare, there are only 3 countries that are overvalued, that have overvalued currencies, where a Big Mac costs more than in the United States, and that's Norway, where it's $6.24, Sweden, where it's $6.12, and Switzerland, right there, where it's $6.76. They have the most overvalued currency in the world and the most expensive Big Macs. So those 3 countries have their currency is overvalued relative to the US dollar. Purchasing power parity theory would suggest that a Big Mac should cost the same no matter where you are around the world. But of course, that's not the case. There are some countries where it costs more, although relatively few, and many countries where it costs less. So if you go down here, right now, Ukraine has the most undervalued currency in the world. The price of a Big Mac in Ukraine is only $1.64. Egypt is also very undervalued at $1.93. Malaysia, very undervalued at $2.28. Actually, Malaysia is a great bargain country right now. From what I've heard, it's a very nice place to visit and quite inexpensive. Their currency is weak relative to the dollar. So, whereas Egypt and Ukraine are both, well, Ukraine, I've heard, is actually a very nice country, but unfortunately in a lot of political turmoil and conflict with Russia. But still could be a nice place to visit and a super big bargain. So if you're brave, go to Ukraine, go to Egypt, go to Malaysia for great bargains right now. All right, well, you can play around with this index a little bit, but it's kind of interesting and gives you a lot of information there. Let's go back to the slides here. So what the purchasing power, what the Big Mac index has found actually in performing that year after year, The Economist magazine has found that there is actually predictive power to the Big Mac index, so it does support purchasing power parity theory. And what they have found is that on average, a 10% undervaluation according to the Big Mac standard in one year is associated with on average, a 3.5% appreciation of that currency in the following year. So that supports purchasing power parity theory, that currency values do balance out on average over time across many countries, not always in each individual case, but in general, if a currency is undervalued relative to the dollar or relative to other currencies, then it will appreciate in the coming year, whereas the reverse is also true. It's overvalued, it will depreciate. So when the US dollar price of Big Macs is high in a country, the relative local currency price of Big Macs in that country generally declines during the following year. So it works on both sides. Undervalued currencies appreciate, overvalued currencies depreciate. But again, that's on average over time, and not necessarily the case for every particular country in every situation. But statistically, it is a significant effect, and it does support the purchasing power parity theory. All right, so that wraps up the discussion on currencies. So thanks for listening, and we'll talk to you later.